Right now, somewhere in the Federal Reserve's data systems, there's a number that doesn't make sense anymore. It's the daily liquidity requirement for the Treasury market, the amount of cash the Fed needs to inject just to keep the $27 trillion bond market functioning. In January 2023, that number was $4.8 billion per day. On December 18, 2025, it hit $847 billion. Not per week, per day. That's a 17,550% increase in less than 3 years. And here's what makes it impossible. The Fed's balance sheet hasn't grown by 17,550%. It's actually shrunk by $1.3 trillion during that same period. So where is this liquidity coming from? And more importantly, what happens when the source runs dry? This is not about Bitcoin's price going up. This is about the plumbing of global finance discovering it has a leak it can't plug. Here's what they're not telling you. At 2:47 a.m. Eastern on December 17th, the Federal Reserve Bank of New York activated something called the Standing Repo Facility at emergency capacity. This is the financial system's panic button, a lending window that only opens when banks can't find cash anywhere else. The amount borrowed in that single overnight session? $143 billion. That's more than was borrowed during the entire first month of the 2008 financial crisis. What triggered it? Bitcoin crossed $106,000 and refused to come down. Not because retail investors were buying, they weren't. Institutional flows showed net selling from spot ETFs. No, what happened was mechanical. At $106,000, Bitcoin's market capitalization exceeded the liquid reserves of the entire U.S. banking system's Federal Home Loan Bank network. That's $1.1 trillion of supposedly safe reserves that banks use as collateral for overnight funding. When Bitcoin, a non-collateralized asset, became larger than the collateral base itself, the math stopped working. The mechanism is simple but devastating. Banks use treasury bonds as collateral to borrow cash overnight. They need this cash to settle trades, meet withdrawal requests, maintain reserve requirements. But treasury bonds are also what the Fed uses to create money. When the Fed buys treasuries, new dollars appear. When it sells them, dollars disappear. Here's the trap. Bitcoin doesn't need treasury bonds to exist. It doesn't need Federal Reserve approval. It doesn't need overnight funding markets or repo facilities. It just is. And every dollar that flows into Bitcoin is a dollar that's not available to collateralize the $27 trillion treasury market. At small scales, this doesn't matter. At $1.1 trillion, it becomes a gravitational pull the Fed can't ignore. J.P. Morgan Chase's chief risk officer sent an internal memo on December 12th, 6 days before the repo spike, warning that non-traditional store of value accumulation is creating structural pressure on dollar funding markets. That's banker speak for, people are taking dollars out of the system faster than we can create them, and the exit door is an asset we can't control. The media framed this as a brief technical adjustment. The Financial Times ran with, Fed smooths overnight lending amid year-end positioning. Bloomberg went with, repo facility sees normal seasonal uptick. Normal. Seasonal. These are the words you use when you don't want to say the quiet part out loud. We just had to inject more liquidity in one night than we did during the collapse of Bear Stearns. Why the silence? Because acknowledging the problem makes it worse. If the public understands that Bitcoin's existence is draining liquidity from traditional finance, not through malice or manipulation, but through simple substitution, then confidence in dollar-denominated assets evaporates. And confidence is the only thing holding the $300 trillion global debt pyramid together. This is where the lie becomes unsustainable. Paper claims on value can be multiplied infinitely. That's the genius and the curse of fractional reserve banking. When you deposit $100 in a bank, that bank can lend $90 of it. The borrower deposits that $90 elsewhere, and that bank lends $81. The original $100 becomes $271 of effective money supply through leverage. This worked for centuries because the exit door, physical cash, gold, tangible assets, was small, slow, and inconvenient. Bitcoin changed the exit door. It's open 24/7. It settles in 10 minutes. It can't be frozen, inflated, or seized without private keys. And it's attracting institutional flows at a rate that's breaking the leverage math. Consider the numbers. MicroStrategy holds 439,000 Bitcoin as of December 2025, worth roughly $46 billion. They acquired most of it by issuing corporate bonds, essentially converting debt into a non-debt asset. When they do this, they remove dollars from circulation permanently. Those dollars don't come back to buy treasuries or sit in overnight repo markets. They're gone, locked in a blockchain address that doesn't need liquidity. Now multiply that by every corporation, every sovereign wealth fund, every pension manager who's realizing the same thing. The Norges Bank, Norway's sovereign wealth fund, the largest in the world, disclosed a $647 million Bitcoin position in November 2025. El Salvador now holds 6,021 Bitcoin. Russia's central bank, banned from SWIFT and dollar clearing, has accumulated an estimated 350,000 Bitcoin through energy exports paid in cryptocurrency. Paper can be printed, Bitcoin cannot. There will only ever be 21 million Bitcoin. There are currently $2.3 trillion in physical and digital circulation. The Federal Reserve can create more dollars by buying bonds. It cannot create more Bitcoin. And the moment institutional money decided Bitcoin was a monetary asset rather than a speculative toy, the Fed lost control of the scarcity function. Here's what the paper-to-physical divergence looks like in practice. On December 18th, when the repo facility spiked, the Fed also announced, quietly, with no press conference, that it was extending the term limit on overnight repos from 1 day to 14 days. This has happened exactly 3 times in modern history: September 2008, March 2020, and now. Why does extending the term matter? Because it means banks can't find enough collateral to roll over their positions daily. They need 2 weeks of breathing room just to locate treasury bonds to pledge. That's not a sign of smooth seasonal adjustment. That's a sign of settlement stress. At the same time, Bitcoin's hash rate, the computational power securing its network, hit an all-time high of 836 exahashes per second. More miners means more energy consumption. More energy consumption means more capital commitment. More capital commitment means more institutional confidence that Bitcoin will be worth more in the future than it costs to mine today. The physical infrastructure backing Bitcoin is growing, while the paper infrastructure backing dollars is cracking. The divergence is not a premium, it's a warning. In a healthy system, digital dollars and physical dollars trade at par. $1 in your bank account is worth $1 in your wallet. But when institutions start preferring an asset that settles outside the banking system, when they're willing to pay lawyers, accountants, and custodians to hold Bitcoin rather than earn interest on treasury bonds, you're witnessing a preference shift that no interest rate policy can reverse. At 11:34 p.m. Eastern on December 22nd, the Federal Reserve issued emergency guidance to primary dealers, the 24 banks authorized to trade directly with the Fed. The guidance, buried in a technical memorandum, authorized these banks to temporarily exceed their supplementary leverage ratio limits. Translation: we're letting you take on more risk than regulations normally allow because we need you to keep bidding on treasury auctions. This has never happened outside of a declared financial emergency. Not during the 2011 debt ceiling crisis, not during the 2013 taper tantrum, not even during the 2019 repo spike that predated COVID. The Fed just gave banks permission to increase leverage beyond legal limits, with no public explanation, no congressional testimony, no financial stability report. Why now? Because the January 2026 Treasury refunding is $847 billion, the largest quarterly issuance in U.S. history. And for the first time since 2008, the Fed is not a buyer. It's a seller, continuing quantitative tightening. That means private markets need to absorb $847 billion in new bonds, while the Fed removes liquidity. Under normal conditions, this works because there's always demand for safe, dollar-denominated debt. But these aren't normal conditions. Bitcoin just proved that safety is a psychological construct, not a mathematical certainty. If an algorithm can store value better than a government promise, then risk-free rate becomes a contradiction. And if the risk-free rate is no longer risk-free, then every asset price, every pension liability, every derivative contract built on that assumption becomes mispriced simultaneously. The last time this happened was August 15, 1971. Gold was trading at $35 per ounce, the official price where the U.S. Treasury promised to redeem dollars. Except foreign central banks kept showing up with dollars asking for gold, and the U.S. vault at Fort Knox couldn't deliver fast enough. So President Nixon closed the gold window. He didn't devalue the dollar, he just stopped pretending it was backed by anything. That worked for 54 years because there was no alternative. You could hold gold, but you couldn't use it to buy coffee or pay employees. You could hold Japanese yen or German marks, but those were also fiat currencies backed by government promises. The entire world was trapped in the same system, a system where the exit door was inconvenient enough that most people stayed inside. Bitcoin opened a new door, and institutions are walking through it. China sees this more clearly than anyone. On November 8, 2025, the People's Bank of China announced it had purchased 127 tons of gold in October, the largest single-month addition since 1983. But here's the detail that matters. They took physical delivery. Not paper claims, not futures contracts, not ETF shares. They flew 127 tons of metal from London and Zurich to Shanghai and Beijing, storing it in vaults that LBMA auditors can't access. At the same time, Chinese state-owned energy companies began accepting Bitcoin for liquefied natural gas exports. Not through exchanges, not through banks. Directly, wallet to wallet, settled on-chain. When a European buyer sends Bitcoin for LNG, that transaction clears in 10 minutes with no SWIFT involvement, no dollar conversion, no Federal Reserve oversight. The payment rails bypass the entire Western financial system. This is what sovereignty looks like in 2026. While the Fed prints promises backed by the full faith and credit of future taxpayers, China accumulates atoms. While Western banks rehypothecate the same gold bar 100 times across unallocated accounts, China demands physical delivery. While dollar liquidity fractures under the weight of its own leverage, China builds a parallel system where settlement is final because atoms don't negotiate. Russia accelerated this strategy after being cut from SWIFT in 2022. By December 2025, an estimated 19% of Russia's foreign reserves were held in Bitcoin, roughly $91 billion worth. They're mining it domestically, using stranded natural gas that would otherwise be flared. They're accepting it for oil exports to India and Turkey. They're treating it not as a speculative asset, but as a strategic reserve that can't be frozen by executive order. The BRICS expansion in 2024 added Saudi Arabia, UAE, Egypt, Ethiopia, and Iran. These nations represent 46% of global oil production. If even half of their energy exports shifted to Bitcoin settlement over the next decade, that removes $2.1 trillion per year from dollar-denominated trade. That's not a tariff or a sanction. That's a mechanical reduction in dollar demand that no Fed policy can counteract. The West has leverage. The East has metal and code. Only one of these is a liability. Leverage works in both directions. It amplifies gains, but also magnifies losses. When asset prices rise, leverage feels like genius. When they fall, leverage becomes a cascading margin call that forces asset sales, which push prices lower, which trigger more margin calls. Bitcoin doesn't have leverage. It doesn't have counterparty risk. It doesn't have overnight funding requirements. It just sits there, secured by proof of work, indifferent to central bank policy. And that indifference is why it's breaking the Fed's liquidity model. This is what a system looks like when it runs out of time. The Fed can't raise rates. That would crash the Treasury market and trigger a debt spiral. It can't lower rates. That would accelerate inflation and destroy confidence in the dollar. It can't print more money without expanding its balance sheet, which it explicitly said it wouldn't do until unemployment rises or growth collapses. And it can't stop Bitcoin from existing. Every path forward makes the underlying problem worse. If they intervene to suppress Bitcoin's price, they validate that it's a systemic threat, which increases institutional interest. If they ignore it, liquidity continues draining from traditional finance. If they try to regulate it into submission, they push adoption offshore to jurisdictions that welcome it. There is no policy response that doesn't accelerate the outcome. The mathematics don't care about intentions. When an asset that settles outside the banking system reaches sufficient scale, it becomes a black hole for liquidity. Not because it's evil or speculative, but because it's better at being money than the alternatives. Faster settlement, lower fees, no counterparty risk, verifiable scarcity. These aren't marketing claims, they're architectural facts. And when architecture improves, the old infrastructure doesn't just decline gracefully. It fails suddenly. The moment enough participants realize the new system works better, the old system loses the network effect that made it dominant. That's what happened to telegraph when telephone arrived. That's what happened to film photography when digital sensors improved. That's what's happening to fiat liquidity as Bitcoin matures. The trap closes like this. Every dollar of liquidity the Fed injects to stabilize treasury markets is a dollar that could flow into Bitcoin. Every institution that realizes Bitcoin is a better store of value is an institution that stops bidding on treasury auctions. Every sovereign that accumulates physical gold or Bitcoin is a sovereign that reduces its dollar reserves. The policy response to the crisis accelerates the crisis. This is not a prediction. This is observation of mechanisms already in motion. Central banks are accumulating gold at the fastest pace since 1967, the years before the Bretton Woods collapse. Sovereign wealth funds are quietly building Bitcoin positions. Large institutions are securing custody solutions and taking delivery. These are not speculative bets. These are balance sheet reallocations by actors who understand that the settlement layer of global finance is shifting. Most people are watching the price. A few are watching the mechanism. Price is volatile, unpredictable, subject to manipulation and sentiment. Mechanism is patient, inevitable, bound by physics and mathematics. Paper can ignore physics for decades. Atoms don't negotiate. Code doesn't compromise. The divergence between paper liquidity and physical/digital scarcity is not a market anomaly. It's reality reminding us that gravity still works, even in finance.